we all know that the government has provided support to the economy in the last 24 months. There's a concern about the consumer's ability to fill in as the government backs away from the spending plate. Would any of you like to offer an opinion as to the strengths and the weaknesses of the U.S. consumer right now?
You know, I think obviously consumer retrenchment is real, it's alive, I think it's happening. I still see some deleveraging continue. If you look at the last 25 years, consumers have obviously saved a lot less while they spent a lot more and they borrowed a lot more. Just some statistics, you know, consumer debt service as a percent of after-tax income has doubled in the last 25 years. And if you look at consumer spending as a percentage of U.S. GDP, it grew from about 68% to 71%. So you can see that the consumer has really powered the economy. I think the strengths right now for the consumer, when I look at it, coming off of a tough time, is that when you look at your own balance sheet, your personal balance sheet, we have seen improvement, obviously, with some of the markets coming back. Borrowing costs are low, so for those of us who can afford to buy the car and the new refrigerator and get the tax benefits, I think we are. And then confidence is up some when you look at some of the surveys. I think the more important part of the conversation is you flip the coin around and what I like to call is headwinds of the consumer right now, because the consumer is one of those engines that pull you out of recessions. And when I look at those headwinds right now, they are running out of borrowing power to some degree. Demographics, let's think about that. You know, the baby boomers are turning 50 plus. The people in their 20s aren't approaching equities, all due respect, a little differently. The people in their 50s, people like myself, we're looking for income and saving for retirement. So, you know, that's changing. We're seeing saving naturally rise. That's going to impact the consumer spending. Unemployment, I think, is still going to persist some, so that's going to be a little bit of a headwind to the consumer. Tight credit lending standards, that's not changing. You know, if you have perfect credit scores, you can get money. If you're on the border, it's tougher. And last but not least, consumer confidence, although improving, is still kind of tough out there. So as I see it, the consumer still faces some headwinds, and that certainly will have some impact on the economy.
I generally agree with all those comments. I'll just add a couple of things. I think overall the consumer deleveraging has begun to occur, but I think there's a lot further left to go. If you look at consumer debt to, if you look at household debt to disposable personal income, that hit an all-time peak a couple of years ago. It's since dropped slightly from those all-time peak levels, but it's still well up since any level that we've seen at any point in the past. So we think that trend will continue. Just the other point I'll make, Gary made a good point about consumer debt service as a percentage of income is double what it was, say, 25 years ago, I think you said. Just don't forget that that debt service is already at that high level in a low interest rate environment. So if interest rates go up, then you know it could be game over for a while for consumers. So that's another risk to the consumer situation, and definitely from a stock sector standpoint, we feel like there's going to be a lot of headwinds, and the consumer discretionary area of the market is an area that we are definitely finding more opportunities to short or assume that stocks are going to fall in the future, as opposed to buy stocks that we think are going to go up in price.
So, as mentioned in the introduction, I look at real estate. And I think if this was perhaps 12, 13 years ago and we had a panel of experts up here, the real estate person would have been way down at the end of the panel. But obviously, real estate's become more important, not just from those people investing in real estate, but for the whole macroeconomy. And so these guys down here that look at the macroeconomy have discovered real estate. So what's going on there? Not good news. I think as the night goes on, I'll try to keep focusing on what's going on in real estate. But there's a good question of, did the real estate market, the boom and the current bust, influence consumers? And the answer to that is yes. If you're looking at the boom, the increase in house prices created such large amounts of home equity that led to people getting home equity loans and so on, that it really did boost consumption. Some estimates that are out there that suggested about a quarter of the growth that was occurring in the U.S. economy during the boom period was due to the consumer behavior that was occurring because of this increase in house prices. Turn it around now, then the fall in house prices that's occurring, reducing the amount of home equity, reducing wealth, is going to be reducing the amount of consumption. And there's really good evidence out there that, you know, savings is up, consumption is down, and actually I think both of those things are related to what's going on in the housing market. A question I think that'll unfold tonight is what's going to happen in the housing market in the future, and that'll answer the question about whether or not we're going into a headwind. I do agree with the conclusion that's out there is consumers are going to have a tough time for the next few years.